Wow, ladies and gentlemen, welcome back. We have Meta as well as Microsoft earnings to go over, and let's just say they were good, not great. And these stocks are performing as such. Meta, at the time of recording this video, is down about 1.5%. Microsoft is up 1.2%, but not nearly up or down to the extent the options market was pricing in. Microsoft was pricing in a 4% up or down. We don't get a lot of the guidance metrics until Microsoft's earnings call, and then even into the next day, you get more analyst commentary and the stock tends to move larger. Now, it's pretty safe to say if we were going to see some crazy, move from Microsoft or Meta, we probably would have already seen it by now. But up or down 5-ish% can really happen without little warning. So here are a couple of the numbers for Meta. Meta Platform sees Q4 revenue 45 to 48 billion. The estimate 46.09 billion. So they raised the higher end higher than analyst estimates by about 2 billion. The low end was lowered about 1 billion lower than expectations. And when you are a stock that is up 100% in the past year, that is Meta, you shouldn't really be guiding for lower than analyst estimates. Now, I know if you factor in the middle, this was actually a guide up, but that low end is kind of concerning to some people because maybe they come in on the low side. And if they come in on the low side, then that incrementally makes things look a little worse for Meta. Now, Meta sees full year total expenses 96 to 98 billion. They previously saw 96 to 99 billion, so cutting about $1 billion worth of expenses on the high side for this year. Meta sees full year capex 38 to 40 billion. They previously saw 37 to 40 billion. The estimate was 38.06 billion. So a bit of a guidance raise on capex. Now, here's the deal. Is it AI capex or is it just other capital expenditures? Wall Street may actually like AI capex. So I think that could be a silent sleeper aspect of this report. But wait, we have more. Meta's EPS easily beat analyst expectations, coming in at $6.03 versus estimates of $5.25. Revenue also beat expectations of $40.59 billion versus expectations of $40.25 billion. Ad revenue $39.89 billion versus estimates of $39.71 billion. So not as an impressive beat on ad revenue itself. Realty Labs revenue $270 million, estimate $312.8 million. Wall Street really doesn't care about that. Operating income $17.35 billion, easily beat the estimate of $16.25 billion. The family of apps operating income $21.78 billion versus estimates of $20.47 billion. So that was really good. Realty Labs operating loss $4.43 billion, estimated loss $4.66 billion, so they lost less than expected. Sees Q4 revenue again 45 to 48 billion, estimate 46.09 billion. So all in all, were these results from Meta bad? No, but by no stretch of the imagination. But when Meta is up this much, you really have to wow investors. We didn't get a stock split news. We didn't get a dividend news. We did not get any exciting AI news so far. And the lack of that is really enough to push the stock at least marginally lower. You didn't see some kind of disaster, but it's just not exciting enough to push the stock to the next level. And Microsoft is going red at the time of recording this video, and here are their results. Microsoft Q1 2025 earnings revenue $65.6 billion, easily beat the estimate of $64.51 billion. EPS $3.30 versus estimates of $3.11. Cloud revenue comes in at $38.9 billion versus estimates of $38.11 billion, and intelligent cloud revenue of $24.09 billion. Azure and other cloud services revenue excluding FX, came in at positive 34%. They beat the estimate of 30.4%, so definitely good, but slightly slowed from the 35% that they seen last quarter. So growth actually slowed down a little bit, enough to cause Wall Street to get super concerned. No, but enough to, propel the stock higher? Perhaps no. Revenue increased 16% and diluted earnings per share increased 10%. Operating income came in at $30.55 billion, up 14%, and they beat the estimate of $29.21 billion. And capital expenditures came in at $14.92 billion. That also beat the estimate of $14.55 billion. That just means Microsoft invested a little bit more money than Wall Street previously expected. Back to Meta just for a moment. They say, quote, "We anticipate our full year 2024 capital expenditures will be in the range of 38 to 40 billion, updated from our prior range of 37 to 40 billion. We continue to expect significant capital expenditures growth in 2025." So it could be that expectation of continued capital expenditures higher than previously forecasted that could be knocking Meta down a little bit. All in all, following the results that we have out today, you have eBay that's down about 20%. They missed. Roku's down 15-ish%. Robinhood's down 15-ish%. You have Carvana, out of all companies, that is the one that did very well, up over 20% upon the last check. The S&P in all is down 0.10% here in after hours following these earnings. You do have Nvidia that is falling another 0.2%, and Apple that is slightly in the red in after hours. If those two give up a little bit, that would be an area of concern over the next day or so before you get Apple earnings on Thursday. Now, Amazon is up 0.1% because these earnings are furthermore confirming that Amazon's probably going to have pretty good earnings as well. So is this a disaster for the markets? Obviously not. Does this really help support the markets in any kind of meaningful way? Not really. And I do think from that perspective, you are kind of vulnerable for any bad news here. Perhaps after these earnings are out of the way, good or not, which I would say earnings season has been pretty good so far. Yes, there was a low bar. You can get into the nuances of this, but earnings from what we got versus expectations have been pretty good. With that said, now that earnings are getting out of the way, we could start to price in some other things like election uncertainty or the economic data that we have seen in the last couple of days. Now, one area of concern continues to be TLT. The bond market is acting crazy these days. There was news earlier in the trading day that the Treasury was stepping in with $30 billion of liquidity to help support the bond market. Now, you're looking at TLT here, which is the actual bond prices. Okay, TLT is a 20-year Treasury. If you see bond prices go down, that means yields are going up. So if the Treasury is saying they're basically going to inject $30 billion into the Treasury market, that means they want Treasuries to stabilize and maybe actually go up a little bit, which would drive down yields. So the Treasury does not like what's happening in the bond market today. And that was part of the news that sent bonds higher. Once that news broke, Treasuries ripped higher. 10-year Treasury yields dropped about 7 basis points in the course of an hour or so. And then you sold all of it off today. You bounced again, bounced around a little bit, and then you ended up closing at the low of the day and then selling off another 1/3% here in after hours. I mean, this is not a good situation to be in. Even Jim Cramer said last night, if 10-year Treasury yields continue to climb higher, markets are going to be in a very bad place. And this recent rise, as of really the last couple of weeks, has not affected the S&P all too much. But if we get earnings out the way with an upcoming election, with fears in the bond market, something just breaking in the bond market, let's be honest, it's kind of what's happening right now, then we set ourselves up for a much larger potential problem. The last thing you want is an issue in the bond market, let me tell you. Now, Ryan Dietrich on X created this chart of really the last call it 20 years or so, where the markets were actually open on Halloween. And this is actually dating back to like 1985. And you can see we've never had an over 1% drop, but you have seen 1, 2, 3, 4, 5 instances where you actually seen an over 1% positive day on Halloween. If we do experience a drop, most of the time they tend to be like a third of 1%. And most of the time you're actually just moving higher on average. The average return is positive 0.34%. And on average, you're green 67% of the time on Halloween, which is going to be tomorrow. Now, I know you hear a lot of people that say, oh, that happened then, or that's the historical precedent, so it means it's going to happen again. I don't fall under that category. I think this is unprecedented times that we are currently living in, with so much uncertainty just gathered here right before a major event, which is the election, and weird things going on in the bond market. The bond market's like breaking in front of our eyes. I don't think we can draw any conclusions, but I will say earnings season so far has been good enough, but not great enough to push overextended markets even higher in a substantial way. But is this enough in and of itself with just earnings to push things lower? I don't think so either. As you get more big tech earnings out the way, they become less and less of a catalyst for markets. And that's exactly what happened here today in after hours. So markets are going to be on to the next thing, which is Apple and Amazon reporting tomorrow in after hours, of course. And then you're going to have a bunch more of economic data throughout the rest of this week, tomorrow and on Friday. We'll go over that in just a moment. But then the big thing is going to be the election. Ryan Dietrich on X writes that October is historically the most volatile month. 2024 said, hold my beer. Not a single 1% close up or down all month, with only 2 days left to go. Over the past 50 years, that only happened in 2017 and 1995. That's it. And David Rosenberg is here to throw cold water on the GDP report today. He says half the growth came from the savings rate drawdown. Real disposable income growth weakened sharply to a mere 1.6% annual rate, then adjusted for the pre-Boeing strike effect on transportation equipment and government support, and stripped bare the economy really only expanded 0.5% in the third quarter. Miracle or mirage? Liz Young Thomas on X writes, Q3 GDP growth came in at 2.8%, a touch below the estimate of 2.9%, while private domestic demand came in at 3.0%. Consumer spending was particularly strong this go-around, rising at the fastest rate since Q1 2023, while residential investment, part of private investment, was weak. And Zero Hedge points out where some of U.S. growth is coming from, and that is government spending as a percentage of GDP, which is continuing to rise, aka deficits. And as reported today, overall PCE is at 1.8%, which Kathy Jones here says, she is the chief fixed income strategist at Schwab Center for Financial Research at Charles Schwab, says is well in line with the Fed's mandate. And David Rosenberg writes on X, another generous seasonal adjustment factor for ADP made the difference between the consensus estimate of 111,000 and the actual 233,000. Don't believe everything you see. Here on the day today, CNN's Fear and Greed Index is coming in at 59, which is still in greed territory, but falling quite a bit from where we were 1 month ago at 73. Even yesterday, we were at 60, and last week we were at 62. The percent of stocks trading above their 50-day moving average is actually up today to 57.45%. 1.48% of all stocks are breaking above their 50-day moving average. And most of this has to do with the outperformance of the Russell 2000. Russell 2000 is up close to 0.5% today. NASDAQ down 0.2%. S&P is down 0.12%. And the Dow is up 0.07%. The VIX is now back above 20, up 3.5% today. Option activity today in the SPY ETF, the main S&P ETF we all use to track the S&P. You have seen 115 different trades totaling $102.23 million with a positive order value of 71%. So it's actually pretty good today. Today in after hours, we do have earnings from Microsoft, Meta, Coinbase, Robinhood, Sonova, Etsy, Riot, Roku, Carvana, and Starbucks. Tomorrow morning, we have earnings from Uber, Peloton, Merck, ConocoPhillips, SiriusXM, Altria, MasterCard, Estee Lauder, Kellanova, and Norwegian Cruise Line. And then tomorrow in after hours, we have earnings from Amazon, Apple, Intel, Atlassian, Eldorado Gold, as well as United States Steel. And then Friday, we have Fubo TV, Chevron, ExxonMobil, and Wayfair. So expect to get a lot more volatility in markets starting today and continuing throughout the rest of this week. Even considering we do have tomorrow's economic data, which we will get core PC price index month over month, expecting 0.3%. Last month was 0.1%, so the lower the better there, that's for sure. Personal income month over month expected at 0.3%. Last month was 0.2%. The higher the better there. And personal spending month over month is expected at 0.4% versus last month at 0.2%. And again, the higher the better there. We will also get initial jobless claims, expecting a rise from last week's 227,000 to 230,000, and continuing jobless claims, which are actually expected to fall around 7,000. So not expecting too much there. Chicago PMI is expected to rise to 47.5 from last month being at 46.6. We have some shorter term bond auctions. That's not really expected to move the markets. And manufacturing PMIs out of China that come out at 9:45 p.m. tomorrow. And then on Friday, we do have non-farm payrolls as well as the unemployment rate and ISM manufacturing PMIs. So it's not just the earnings, it's also the economic data, and to a lesser extent, does the election start to get priced into markets? Do we start to feel the uncertainty of the election, or do we not? That is an open-ended question that we just don't know until we see it. So let me know what you think about all of this information down below in the comment section. Are you bullish? Are you bearish on markets? I would love your thoughts down below. With that said, you guys have a safe rest of your day, and I will see you in the next one.